the bulk of them are right here. A lot of liquidity resting below these lows. So as we know that, we can say, okay, a lot of liquidity resting below those lows, knowing that we have to free up liquidity prior to moving, we're probably going to see some sort of manipulation down to then buy up. Even if this wasn't here, you would understand that there's liquidity. So if we're trading bullish, we want to be looking for sells to buy, right? But now that we know, well, there's a level here and it has a lot of these technicals that I just went over, well, it's probably going to react off this because one, this is just highly probable to begin with, but two, we're building liquidity prior to this level, which makes it even more highly probable.
Folks, if you missed out on joining the Trading Nut Funded Cup, don't worry. With over 3,000 traders registered, my sponsors City Traders Imperium have decided to run another, but this time they've promised the prizes will be even bigger and better. Folks, if you want to register for this and show your skills as a trader, click on the link above or the link below the video or in the podcast description, then sign up for free before 15th of June 2022 and get 10% off any City Traders Imperium product just for entering the competition. Good luck, folks, and we'll see you in the cup.
What is going on, Trading Nut community? I hope you all are having a wonderful day. I'm so excited to be sharing this with you all today. This has been a video that I've been wanting to make for quite some time now, and I'm finally able to get it all to you. Now, if you have watched through the Trading Nut YouTube, all of my smart money concepts videos highlighting everything from market structure to sponsored candles to volume to imbalances, pretty much talking about all the different facets of smart money. This video will be tying it all together, giving you that holistic understanding of not only how to put together all of the tiny little individualized details within smart money, but taking that and putting it all together in something that you can understand and start applying today. So I'm going to be going over just one pair, and I think this pair and this example really brings out what smart money means, how to trade it, how everything works, and how to really tie all of your confluences together. So sit back and relax, take some good notes because this is very valuable information, and I'm giving it to you guys all for free today via the sponsorship of Trading Nut. He has been a wonderful host to my videos. Feel free to check out all of his videos. He has done a wonderful job collaborating with many great traders. I'm very, very appreciative of the time and the effort he has put into working with me to give you guys all of this content. So big shout out to Cam from Trading Nut. Now let's get right into this all-encompassing smart money concepts video. So here we're talking about Euro NZD. And if you know me, if you know our style of trading here at Aerial FX, you know anything about smart money and how we trade it, you know that we always start with what? Market structure. Very important. So we're zooming out on the daily time frame and let's take a look at what we have going on. So we can see just by the swing points, we are making lower lows and lower highs. This was a mere liquidity run. And then we had our lower low to the downside. Okay, that lower low was formed. So naturally we should expect a lower high into another lower low, continuing with higher time frame market structure. Now, this is a very interesting part right here. This level where we swept liquidity. Many people think that this is a break of structure. And at this point in time, you could classify it as a potential break of structure. But we can see we swept liquidity right back to the downside, had no wave play whatsoever. It was just straight lower time frame resistance run, lower time frame liquidity run. We were just continuing with no pullback whatsoever. The momentum has shifted back to the downside, really within these candles here, because we had our straight buying volume and a straight selling volume. So you could imply that because this high here was taken out by this one candle and then an immediate reaction to the downside, you have to have that in the back of your mind where we could just run the liquidity, come up into something else to the left, which we did, this area, little tiny area of supply here before falling over. What I really wanted to see was I wanted to see a reaction from this demand level. So after we had swept liquidity, I wanted to see some sort of reaction from it and continuation to confirm the momentum to the upside. And we never had that. So we can see that at this prior high, this is the candle that swept liquidity. We came back down. Where is our nearest area of demand on the lower time frame? It's right here because we can see higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Now scaling into this level. So after the liquidity run was seen with this black line, that was the high over to the left. We can note that this is our next level of demand that we should react from to continue with the overall structure. Okay, so we had the reaction, very tiny reaction, but we had some sort of reaction, but it was more of like a consolidative reaction around this level. There was no expansionary move. There was no momentum shift. There was no accumulation. There wasn't anything going on within this demand zone. I patiently waited, and then we had our breakout to the downside and continuation. So what this told me was that after the liquidity run to the left, we had the buy to sell. We came into our most recent area of demand. We never followed through. We never made that higher high. We created the higher high here, the higher low. This demand is now invalidated because of the break and close below this level. Because we invalidated the demand, we never made the higher high. To validate this demand, we wanted that higher high to form. So now that we invalidated it, now this turns supply. It flips into supply. So now this becomes a supply level in which we look to short. So it's very, very important that we understand how to identify the difference between the actual counter trend breakup structure and a simple liquidity grab. Now, I go over this in more detail in our course and how to really understand and distinguish the difference. But this is still a really good example of what I mean. We can see the liquidity run. We never maintained our momentum to the upside. We fell right back down, came into the prior demand, and then we broke the demand. Flips into supply. Now this is seen as a buy to sell. Sponsored, institutionally based sponsored move, and now we should be looking to sell. And really that just confirmed it when we eventually made the lower low down here. So now, since we have our overall area of interest of supply, once price starts to pull back, we can potentially look for, well, one of two things. One, intermediate buys, so intraday buys, intra-week buys into this level, but then overall sells really from 1.7 cycle level, 1.71 round figure, right? So this is the supply level in which we want to come into, because as we can see here, this is just low resistance. This is a lot of imbalance on the higher time frame. If I head to the weekly, that's probably straight imbalance. As we can see, between this wick, just straight imbalance in here. No buying was offered, just all selling volume. So we have more room to go to the upside. So many people ask me, well, you're trading counter trend. If the trend is bearish, why are you looking to buy? Well, I understand that, and it's very good that people ask me that question because they're paying attention. It tells me that they're listening. However, you can still trade counter trend against the trend if you have more room to go to the upside for one, or the downside, but in this case, the upside because we're pulling back bullish, right? If you have more room to go prior to coming into a level, and two, if you have all your regular confluences for a buy. Smart money-based confluences, sell to buys, market structure, imbalances, EMAs, all the good stuff, time and price. I could go on forever. You have to have the main confluences first. You have to break counter trend structure, which I'll get into in a minute, which we did here. And you have to have a target. Now, what if you had all the confluence in the world for a trade in here, which I'm going to discuss with you in a minute, but price had already come up into this level first. And now we're trading back down, whatever, and people wanted to buy here, and then it broke right through. Well, many people wouldn't have seen that we actually came up into the supply level already. So the higher time frame level had been achieved. Now we could be looking for a lower low ultimately to take out this low. Okay, so but because that has not occurred yet, we still have more room to go to the upside. So let's go down into the 4-hour time frame and look at where we broke structure initially. So that's kind of weird price action, right? We did sweep this low here. That's really all that matters. We swept the low. I guess you could continue to sell in here because we are technically still bearish within this time frame until we broke counter trend structure, which we did here. So we swept liquidity and then we closed above our most recent structure level. So we closed above it. We pulled back and continued. And then we found intraday setups within here that I'm going to talk about, and within here that is still valid. And we still have room to go to the upside, so we can continue to look for buys. We are counter trend bullish now. So now this right in here, between April 25th, let's call it, and say May 5th, so about 10 days, I talked about this with our VIP members. I gave them the full breakdown, the full case study prior to the level that I bought it from, 1.62 actually, before that was even met. Okay. So having said that, I'm going to break it down again. Our VIP members already know this. I've said it probably about 10 times already. And I've discussed the smart money concepts behind it and the technical reasons why this played out so well for us, or well, this blue box, this area of demand played out so well for us. Not just because of structure, but because of these tiny little things that are going on here in regards to time and price, in regards to liquidity, in regards to imbalance fills, all that good jazz. So let's go down to the 15-minute time frame. I think that's a good place to start. So as we know, we had finally broken counter trend structure with this high here as compared compared to the high here. We finally broke above it, right? So I guess you should be looking for longs, at least intraday longs. There was nothing in here to show me that we were going long until we made the high here. We had an area of accumulation, lower time frame, 5-minute time frame. I know I'm on the 15-minute, but if you go down to the 5 minutes, you can easily see the wave play. But we can see selling climax right before the liquidity, secondary test, BOS, spring, test, continuation, break of counter trend. You can see lower low, lower high, all the way down, lower low, lower high, lower low, higher high. Structure has shifted, and look at where we sprung from. We sprung from taking liquidity. So we swept liquidity, and then we sprung. We tested and we continued. So really my eyes go, once we have tested and continued, my eyes go here with this demand level. Where in here can I be buying? Also, you can also be buying somewhere in here because of the break of structure following the liquidity run. Liquidity run occurred. We had the spring. I believe we had price volume divergence as well. Let me check. I really don't remember because this was a few weeks ago. And yes, we did. Easily shown here. If you just look in the indicators tab at the top, type in VFI, it'll come up with this. And price is falling. However, volume is rising. Price and volume are diverging. It's a good indication of a potential reversal. So we should look for potential reversals around this, obviously using other confluences to justify our trade. And in this case, we understood that we are now counter trend bullish with the high that was broken. We swept liquidity, we accumulated, diverged, we broke structure. So now the pullback for a continuation is in order. Okay, so now I'm going to do bar replay here. Where could we have found an entry? I personally didn't take this trade. I didn't see it in time, so I make no claim to taking this trade. But in hindsight, we can go back and look at what happened. I know it's easier in hindsight, of course, but if you understand that the concepts, you can take advantage of this real time. As we did in a couple minutes, I'm going to show you what we took advantage of, but you can still take advantage of the same thing. It happens every single day. So after the break of structure, where do my eyes go? Well, we can see here that this last point of selling volume before the run, we came down and we filled in balance. We tested that demand level. So this is really taken care of. We don't really need to come any lower than this level. And then we have the imbalance here. We can see the higher high, higher low, higher high, higher low, higher high, right? Lower time frame. So most recent structure says here, this is our most recent area of demand. We have an imbalance here. Imbalance of this wick between this wick and this wick here. So there's imbalance. We already filled imbalance here, so I really didn't see the need of trading any further down than this. We actually did just by a few pips, but really your stop loss should go below. I would have entered here right at the imbalance fill. It's also probably about the 50% if you pull a fib. Yep, just below the 50%. So we know we are trading in discount. So that's really good. You never want to be trading above the 50%. And then we're going to be looking to buy. So that's really where you would be looking to buy. All right, so going back out of bar replay here, I'm going to go to the 15-minute time frame again and zoom out. After we had the spring, we made the higher high overall. You can see the lower low, lower high, lower low, higher high. So now this time frame, we are counter trend bullish again. So now we already know that we're counter trend bullish here because we broke and closed below the higher time frame structure here. But now we did it again here upon the pullback. This is within the pullback, and now we're counter trend bullish. So now we know we're higher time frame bullish and now even lower time frame bullish here because we have closed below the prior swing point of the pullback phase. So now we know once we have closed above it, the structure, we have confidence that we can pull back and place our stops below the low because now we know we shouldn't come below this level since we broke counter trend structure. So you can see how on higher time frames and lower time frames it looks the exact same. That's why I say the markets are fractal. They are fractal, and everything happens on every single time frame. Have you ever noticed? You ever seen like a kaleidoscope? You have one of those things as a kid, and you look into it, and it's just a mirror of patterns, large and small, and it's just like a flickering of the same thing. Or you ever seen those videos where it's like one big object and it keeps scaling into a smaller object, but then that smaller object becomes the bigger object, and you keep scaling it even more? That's exactly what fractility is, if that's even a word. It's fractal, meaning everything happens on the same time frame. It looks the same, whether you're looking at it from a large perspective or a small perspective. Like higher time frame, in this case for Forex, higher time frame and lower time frame. So once this occurred, you want to be looking for obviously a pullback to continue long. So really where I'd be looking for would probably be in the same region here, below these lows, because these are equal lows. We made the high, we made the low, we made the higher high overall. We closed above this level. We didn't close above it here. We made relatively equal highs, but now we closed above it here. So now I want to be sweeping this liquidity, coming into something further in here to test the accumulation again. So as we can see, it's probably going to be right there in that little demand level. But now we've created equal lows. Now price starting to chop around. We came down, we tested the low again. Now we made triple lows. So there's these triple equal lows. We push back up, we push back down. Now what's going on right in here? Well, we have to understand time and price, liquidity, structure. We have to put every confluence together in order to form a buy. bias. Obviously, we have the higher time frame bias is long. The lower time frame, I guess you can say, if you're looking at this lower low, lower high, lower low, higher high. Now the structure shifted up, but now let's look at what's going on in here. What time is this? This is Asian session for me, at least. This is all Asian session, just consolidation. That's why I never trade Asian session. I only trade London and New York because that's where you see the manipulation occur and your pertinent setups. So let me draw it up. Triple equal highs. This low here in Asian created the triple equal lows. Okay. We never swept liquidity. We also took equal lows here. So this could have been seen as a breakout. Sell. Many people trade, but when they trade below support, they sell it. Guess what? Right back to the upside, taking their stops because they place it above the high. Now, second point, we have the Asian range, which is from this high to this low. We're in the trading range, right? Oftentimes what will happen when New York session or London session come up is we'll have a sweep of the prior New York session's high or low in the correct direction of trend. What I mean by this is that we swept liquidity here. We enticed the buyers. They trade the breakout. They bought above resistance. They're placing their buy orders upon the engulfing candle's closure, stops below the low here. Obviously, we come down and sweep that again. We take their stop losses. We also entice the buy stops, right? So not only when they close, they buy, but when they place their buy stop a couple pips above the high, because if it breaks out, it should continue. Well, that's just retail. It doesn't work. And obviously, the banks know that because they know exactly where the liquidity is. So retail traders, they place their positions here and the buy stops are triggered, stop loss below the low. Now they come down and run the low. Now what happens? We create equal lows, support, engulfing below the support. Sell stops are placed, engulfing, placing your sells because we got to trade the breakout. The retail, you got to trade the breakout. Nope, right back to the upside, hit your stop loss, stops above the high here. So now we saw really in here a sell to buy to sell to buy, or really from the Asian range, a buy to sell to buy. It's all just where is the liquidity? That's the number one question you have to ask yourself when approaching London, New York session. Where is the liquidity? And the banks know this. They know exactly where your stop loss is. It is no fault, your own or their own, that, I'm trying to think of the right word for this, they have everything in front of them to screw you over in the nicest way possible. They have everything in their hands to screw you over. That's why retail traders don't win. You have to have the clues of the big banks in order to trade professionally and profit. So you may be thinking, and I've done this before too when I first started trading, oh, they come up and hit my stop loss and then it reacts right. I sold it right in here, hits my stop loss I bought it, hits my stop, and then it rolls right back over. Oh, I entered a short position here and then it hit my stop loss. Well, why did it reverse right where I decided to sell or buy it? It's because you're looking at it from a retail lens, a retail perspective. So many people say, and they come to me and they say, well, it oftentimes feels like the banks know exactly where I'm placing my stop and they come run it by a pip and they're only targeting me. Well, that's partly true and also not true. It's partly true because, yeah, they are targeting you. They are targeting your liquidity, but it's not just your liquidity. It's many people's liquidity. Many people trade the same way. So when many people trade the same way, that volume starts to increase. If they're buying above resistance, they're going to be placing their stop loss here. Many people are doing that. Retail pattern. Banks know that. They know exactly how much volume is where. It's just a part of their system. They know exactly how much volume, how much money is resting here. $75 million? Okay, great. $150 million here, maybe $15 million here. I don't know how much, but they know exactly where the volume is. And they know exactly where the stop losses are because that's where the liquidity is. Because if you pump price back down to take their stop loss, they then have to sell back their position. Because if they're buying, then they have to sell back their position when their stop losses hit. Freeze up liquidity. So they take the liquidity, they move in the opposite direction. Take the liquidity, move in the opposite direction. The overall direction is long. So why even look to be shorting in the first place here? So you really should be looking to long this. Now people say, well, I longed it here. Well, you didn't place your stop in the right area and you didn't buy at the right area to begin with. You got fooled by the liquidity that was resting here. You got fooled by the resistance. So buy to sell to buy. Okay, so now once we have made that higher high, this becomes the area of interest for me because at the time of day, 3 o'clock in the morning, this is prime London session time, actually 3:30, we had the buy. London session open, we bought back up, swept liquidity, come back down. 8 o'clock, New York session open, really London to New York session exchange or changeover. New York changeover, we manipulate price, push it to the downside, and then right back to the upside, coming into our original level of demand right there. Even if you had no idea what was going on in here, you could have just simply placed your fib level level and pulled back into this level of demand, or to test the accumulation into discount, you would have been fine. But people love to scalp and they love to get caught up in all these stupid moves, and they don't really know how to trade, so they get stopped out here. And I've been a victim to it before when I was younger. When I first started trading, I'm sure most of you, or probably all of you, have as well. But understanding and waiting for the clues to arise. So now that we understand what has happened in here, now we can take advantage of this level. We have the major sell to buy. This becomes the demand. And we're continuing in trend, higher high, higher low, higher high. So understanding the technicals, this paints the picture for this being a highly probable zone. So now that we know that, we have made a higher high now, higher high in comparison to this high. Now we want to pull back higher time frame and continue long. So we see the higher high, the higher low, the higher high. So now this is the higher low and the higher high. So now what's going on prior to coming into this demand level? Well, we can see a lot of consolidation. And what these institutions do is they love to generate liquidity prior to coming into a level. Happens all the time. I say it every single day. They love to generate liquidity prior to coming into a level, because what do they have to do in order to place all of their orders here? They have to free up liquidity. Because they're placing probably hundreds of thousands or potentially a million lot size volume. I could be totally wrong about the volume size, but it's a lot. So they have to free up enough liquidity to take it. If there wasn't enough liquidity, they couldn't place all their orders. So that's why they have to free it up in order to do so. So that's why you see the sell to buys and the buy to sells. They have to free up the liquidity. They have to take liquidity in order to enter their bulk position. They don't care about you placing your tiny little 0.1s. They want to know, how am I going to place my million lots, standard lots, in order to get in this trade long? You can't do it here. You're going to slip. There's not enough liquidity for you to place it at that exact price. So that's probably why they came back down and tested that same again, because they knew they were going to push up. So they got in here, came back down, freed up more liquidity in here to take and enter the rest of their contracts here to go long. But anyways, the bulk of them are right here. A lot of liquidity resting below these lows. So as we know that, we can say, okay, a lot of liquidity resting below those lows. Knowing that we have to free up liquidity prior to moving, we're probably going to see some sort of manipulation down to then buy up. Even if this wasn't here, you would understand that there's liquidity. So if we're trading bullish, we want to be looking for sells to buy, right? But now that we know, well, there's a level here and it has a lot of these technicals that I just went over, well, it's probably going to react off this, because one, this is just highly probable to begin with, but two, we're building liquidity prior to this level, which makes it even more highly probable. In addition, we're creating and generating equal highs. Look at those equal highs, perfectly equal highs. It's the draw on liquidity. Where is the banks and institutions looking to target next? These highs. So when we come back down into our buy zone, we have more confidence to buy this, not only because of other confluences that I just mentioned, but two, because there's more liquidity up here that we need to take. They're not going to leave equal highs and equal lows forever. Sure, they may not be taken right away, but it's always liquidity that they have to free up and they have to take. So they're going to run the high. It gives us more conviction that we're going to continue long. And that's exactly what happened. I placed my order at 1.62. Psych level into this demand zone was perfect. You could have probably placed it at 6, well, maybe 50% of this. Didn't quite come down to it. But that would have been another viable level, 50% of the zone. But I placed it at 1.62 because that was the round figure of the psych level that was present. And hence why we reacted right from it. Psych levels, round figures, that's where they're placing the bulk of their orders. That's where most of the liquidity is resting. So continuing up now, higher time frame. So now that we have gotten in the position here, what else did we see? Just like as we saw here, sell to buy, liquidity run, all that good jazz. Now we have this sell to buy because of liquidity freed up into the demand zone, continuation, expansionary move. Higher high was formed. Now we're starting to pull back. Well, what do we have? We have more room to go to the upside. Any pullback should then facilitate another higher high. So we should continue to be looking for pullbacks into our higher time frame zones to then buy. So I'm interested in buying at 1.63. Hasn't happened yet, so it's almost like a free signal for you guys. 1.63 is my intended area to look for longs. Psych level, round figure, we're into discount, we're into this lower time frame zone here, right? Also, this 1 hour time frame demand. We had the liquidity run, the sell to buy, the repricing event. Talk about the repricing event. Happens all the time. It's just the way the bank algorithms work. Repricing event, expansion, imbalance move, imbalance, psych level, repricing, 1 hour demand into the higher time frame or region of price, and then came into this sell to buy here, institutionally sponsored. Higher high was formed. These are the levels. So now same concept applies to the higher time frame as to the lower time frame. We are overall bearish, but we have confluence to be looking for buys up into this level. We're overall bullish on this time frame, but now we have confirmation to sell short for this pullback because we have more room to go to the downside into here. And you wouldn't just like look at this and be like, well, I'm going to sell it right here just because we have more room to go to the downside. No, you have to confirm the sells first. So we did that by saying, okay, Well, we made the higher high, higher high, lower low. We broke below structure. Now we're in this pullback phase. We created relatively equal highs in here. We're just chilling now, made another lower low, came up and swept liquidity. All this liquidity, all this descending liquidity was swept. Buy to sell. Let me go into the 15-minute. So all these highs were run. Now let's go to the lower time frame. Higher high, higher low, higher high, higher low, higher high, low, high, low, high, low, high. This demand, most recent structure point, right in here, a little bit of reaction, lower low was formed. The demand was invalidated because we never made the higher high. Flips into supply. I know we didn't react right off this level, but really, it's really this level in here. You could place your stops right above the high if you were to sell that. Now, it's not very clear because it wasn't a great, strong break of structure. I really would have liked to have seen more of a volatile move, more momentum to the downside. But the concept still applies. Pulls back, could have entered in off of the imbalance here between that wick and that wick. Stops above the high, had a great risk to reward right there. Then we broke to the downside again, just confirmed it for us again. Into imbalance, sell-off, major sell-off. Confirmed the sells for me at that point. So now we look to pull back. Market is pulling back. I've sent this out. I had two levels here. One right here at the last buy to sell institutionally sponsored volume that broke counter-trend structure, right? Because we closed below the most recent swing point in the lower time frame after sweeping liquidity. Buy to sell, that level, and then our most recent area of supply. All right. We never pushed up into that. Had two levels. Had to delete this one right there. It's okay though. We're still in this one. Had pretty much a wick entry. If you look at the higher time frame, it's basically a wick entry. But now we can keep scaling in and looking for continuations. And what really took the cake for me was the reaction here, the failure of the most recent demand zone, the failure to make a higher high, the invalidation, turning of supply, and the break of structure again on this time frame. You can see higher high, higher low, higher high, higher low, higher high. Well, this is the low that made this high, and then we trickled up here again, higher high, higher high, lower low was formed. That's why we never broke and continued above here, because we broke structure. Pull back short, pull back short. These two levels were areas of interest for me. Most recent area of supply, and then the area of supply that hadn't been mitigated yet with a little bit of an imbalance in here. Had two levels just in case, and then we started to trickle back up. What happened again? Look at this low here. Look at this low here. Equal lows. Go to the higher time frame now. 1 hour time frame. Relatively equal lows. So now if we start to short off from here, if we're looking to sell it because we have all this confluence and we have more room to go, we also have the draw on liquidity, the equal lows to take. That gives us more conviction that now we're going to fall and take this low here. So that's exactly what happened. We had a little bit of a reaction from this level, and then we, pushed down. We never really broke counter-trend structure. We're still making higher highs, higher lows, and lower time frame, right? Which is why we probably made a higher high here. We just fell short of this level that I had marked up. But nonetheless, then we broke structure. Then we cleared this low. We now shouldn't come above this level. We now should trade below the equal lows here into our higher time frame zone now. Looking for that pullback, we just pull our fib from the high to the low here. You can see that the negative 61 almost lines up with that 1.63 level. I don't really take fib extensions into consideration that much. They really don't mean much to me because it really doesn't have much to do with actual supply and demand levels and liquidity. So I tend to disregard it, but if they line up, it's good confluence. So we can see that we made the lower low, lower high, lower low, lower high, lower low. We broke that structure. Okay, now two levels here. One was the most recent supply. Okay, most recent supply, and then the imbalance in here. Thought that if we pushed up any higher than this, that we could come into the imbalance, potentially up into this region and sell off. We had a nice reaction this morning, and then we have relatively equal low here. Look, equal lows here again. We're trickling back up now, but ultimately we really should roll over to the downside. That's really the bias here. That's really where we should go. We also have a lot of liquidity in here as well. So that will be run. It's just a matter of when. Okay, so ultimate targets. And I've called all these levels out. I've called a couple weeks ago in April, I called this level out 1.62, talked about all of this. I called out 1.63 and this 1 hour supply or demand. Hasn't hit it yet, but nonetheless, called out this level here. I called out this level here and this level here. So it's just understanding the smart money concepts behind it, understanding structure. Where's the structure? Where's the liquidity? What's the bias? If we can identify that, then we can go from the higher time frames all the way to the lower time frames to take a trade. So many people ask me, what time frame do you trade? It's such a stupid question because you can't trade just one time frame. I get really upset when people ask me that question because it's just ignorance on their end. And I can't blame them because, a lot of people are new, they're looking to learn, which is fine. It's great. I'm willing to teach you, but I'm trying to help you understand that you can't trade one specific time frame. You just can't. It's not how it works. And if you think you can, I'm sorry to let you know, but you're wrong. You have to have that holistic point of view, because how did I know that we were not going to go long, let's say not going to go long from here because we broke structure, or we weren't going to go long here because we broke structure here? How do we know that? Well, we have to take into consideration all these different things. We have to look at the higher time frame and lower time frame structure. Yeah, sure. If you just want to trade one time frame, fine. Look at the 1 hour, 4 hour, and then we can just trade these swing points in here, right? But there's so many other opportunities to get in. So what if on the higher time frame we came into here, right? We had the reaction, right? And we went long. So now your stop loss is, let's just say it's below the low. So let's say that's 50 pips. That's probably more because this is your NZD, but let's just say at 50, and then we're targeting 500, so 1 to 10. Okay. Well, now what if you understood liquidity, time and price, accumulation, imbalance, all these different concepts that you can apply the same thing to on a lower time frame once we approach this 1.63 level. So when we approach this level, what if we're looking for areas of accumulation, areas of imbalance, areas of liquidity, time and price? Where did it sweep liquidity? Where did it come into? Is there an imbalance? Is there a demand zone? Where is it? Discount or premium? Understanding that we can get a better risk to reward. Now stop and go below that low instead of all the way below this low. Now this is only 5 pips, let's just say, and I know it's more, but 5 pips. And now this is, 500 pips. And now we have a 1 to 100 instead of a 1 to 10. You see how you can free up so much risk reward? Now you don't have to be overall, your win rate doesn't even have to be that high. Heck, my win rate's not even that high. My win rate's probably 60, 70%. However, I have high risk to reward. So even if I lose, I don't care. I do win more than I lose, but I don't even have to. I can be 30%, win rate, 30% profitable, but be more profitable because I have high risk to reward, right? So, even with just this trade here, even with just this, let's just go over this example really fast. 1.62 is where I bought it, lower time frame. I had an 88 pip stop. Now, I did look to scale in here. I did scale in here. There was just no opportunity for me to get in off of any lower time frame smart money move, right? So if there's no confirmation, then oh well, at least you're in the market and it just kind of reverses and keeps going up and now you're making profit. No confirmation, oh well. Now, if there was confirmation on a lower time frame, I would look to add a position and then have a better risk to reward, a lot better risk to reward, and go from there. But now I pull this all the way up. Let's just say 1.7. Let's call it 1.7 psych level, as we preach psych levels here, aerial effects. So 88 pip stop. 88 pip stop. If I go to anyone and say, hey, I have an 88 pip stop, is this a good trade? Many people are going to say what? No. They're going to say no. Why? Because it's 88 pips. Well, what are they lacking in understanding? They're not understanding the concept of percentage return. If you understand percentage return, it's the 1 to 9 risk to reward. I'm risking 1% to win 9%. If I lose 8 trades in a row on a 1 to 9 and win the 9th one, I'm break even, or I'm probably maybe in a little profit. But you just see, your win rate doesn't have to be that high. 88 pips sounds like a lot, but what's your return? Well, it's 800 pips, or excuse me, no, maybe it's 800 pips, something like that. It doesn't matter. 800 pips, 1 to 9. That's a freaking good trade. So many people are saying, well, I don't have more than a 20 pip stop loss. Why? Because you just think that more than 20 pips is not good enough. It's too risky. It's not how you trade. It doesn't matter. If you use position size calculator, and I've said this many, many times, put in your pair, Euro NZD, trading USD, count size, say $100,000, or risk ratio, 1% risk per trade, stop loss, 88 pips. Calculate, I use 1.75 lot size on this trade here. Because if I lose 1%. If I have a 23 pip stop loss, now I can use 6.71 lots. If I lose, I still lose 1%. Granted, I would make more because my stop loss is lower, and that means probably risk to reward is probably higher. But still, this is the 1 to 9. 80 pips doesn't matter. 1 to 9 risk to reward, it's good money. Because at the end of the day, what makes you money is not pips, it's percentages. And the quicker you realize that, the quicker you'll probably be wealthy within Forex if you practice all of this stuff. So you guys are looking for price to long from 1.63, potentially deeper into this blue box here. It's a 1 hour demand. Looking for reactions around this level to add more confirmation, continuation buys. Overall target on this on a higher time frame is that 1.7 to 1.71, 1.716, maybe 1.72 level. But getting back up, having that extension leg to the upside, if we pull a fib from the most recent swing point, we can see that if you have the pullback deeper into discount, 78.6, 80% retracement, and we have that negative 27% fib extension lines up with the beginning of that supply zone right there. So guys, that's pretty much the bulk of how smart money works. There's so many different confluences. There's market structure, there's time and price, there's supply and demand, there's institutionally sponsored volume, there's volume price divergence, there's imbalance, there's liquidity runs, there's so many different things. And if you know how to put them all together, like I have here and I've showed you, then you're going to be successful. So if you already know how to do this, if you don't, one, let me know. Hit me up. I'd be glad to work with you. I want to work with you because I want to teach you how to do this every single solitary day. Not every day will a setup occur, but if you look across the board, you can find probably something. That doesn't mean to force a setup. Obviously, you have to have confluences in order to trade. But in all reality, there is probably a good chance that you will find a couple setups a week similar to what I've been talking about here. You just have to put in the time and energy to do top-down analysis on these pairs. It doesn't have to be Euro NZD. It could be any pair you trade. And just do your proper due diligence. And I'm sure something will come out if you're patient. 2, you you have to have a good risk to reward. 3, you have to have a trading plan. I have a whole trading plan for you guys. It's Aerial Effects proprietary trading plan. And if I work with you, I can definitely give you that. But if you already know how to do this, what you need to do is if you don't have your risk management right, if you don't have a nice trading plan, if you don't have, I don't even know what you possibly have, goals and whatever, just stuff that professionals need, patience, just when to fold them, when to put the chips away, whatever you want to call it. If you understand the concepts, then you're on the right track. But you have to learn the professional disciplines of patience and risk management, risk to reward, percentage return, compound interest, growth, consistency. Don't have to worry about win rate, worry about risk to reward percentage wise. But if you don't know how to use these concepts, well, I highly recommend reaching out to me or even watching some more of the Smart Money Concepts videos that I have posted on the Trading Nut platform YouTube. Really will give you a deeper insight into the individual components of Smart Money Concepts. So I break down in detail, or as much as I'm willing to give out, because I saved pretty much the bulk of my trading secrets for the course members in the VIP. But the videos, they go over the individual components of smart money. What is an imbalance? How to identify it? How to identify market structure properly? How to identify the difference between the trend reversal and a continuation? How to use EMAs as a part of your trade, stuff like that. Bring it all together in a video like this. So guys, I hope you enjoyed this video. I hope you gained some knowledge and some value. Leave a couple comments if you want. Leave a like, subscribe to Trading Nut YouTube, anything to show some love. That would be great. Give me your honest feedback. Disclaimer, I'm not a financial advisor. I don't claim to be. All this is just educational material only. And yeah, so hopefully you guys enjoyed this. If you have any questions, please feel free to reach out. Questions are always free. I'd be happy to help you in any way possible, and would love to work with you guys if you're really interested in taking this to the next level and transforming your trading into something that can really produce you some good value and some good money for the rest of your life. So thank you guys for your time, and let's take your trading to a whole new level. Thanks for tuning in to this special podcast, or special video on Trading Nut Community for Aerial Effects. Thank you guys so much. Have a great rest of your day and happy trading.